I'm Paul Sanger for the Finance News Network, and today I'm talking with IVE Group. IVE Group, trading under the ASX code IGL with a market cap of 350 million, is Australia's largest diversified marketing communications business. IVE brings together the capabilities, specialists and technology to make customer connections seamless, or as IVE puts it, it manages communications and marketing from idea to execution. We have with us today Matt Aitken, the Managing Director. Matt, welcome to the
Thanks,
network.
Paul. Thank you.
Good to have you here. Now, Matt, congratulations on a really strong FY24 performance. All key profit metrics are up with solid margin expansion. What were the primary drivers behind this uplift, and how do you see these trends continuing into FY25?
Yeah, thanks, Paul. We're really pleased with the FY24 results. A very solid result for the group. Revenue was pretty stable at almost $1 billion, but we saw good margin expansion, as you've said, across our EBITDA line at $128 million and our NPAT line at $43 million. And a lot of what ultimately was driving that too was the increase in our material gross margins, so in our profit margins as we climb back towards pre-COVID levels in that space, as we start to see stability in our cost of goods sold and our raw materials and in our supply chains, and we create some of that margin expansion. We also concluded a number of key projects through the year, which we'll talk about soon, no doubt, but the Ovato integration concluding just prior to Christmas was a big part of addressing some of that margin uplift.
Yeah, and you mentioned that while NPAT and margins were higher, they were impacted by increased net finance costs. Can you elaborate on the factors contributing to these higher costs and how the company plans to manage them going forward?
Yeah, I think that's really just calling out that relative to PCP, our net finance costs were higher as a result of increased interest rates from a senior debt perspective. But conversely, the company's done a fantastic job at strengthening the balance sheet through the year. Our operating cash flow conversion was 114%, and our net debt now is 1.3 times pre-AASB 16 or 1 times post-AASB 16. So, the balance sheet is in an extremely strong position, but that call out an increase in net finance cost was more so relative to PCP.
Yeah, you've navigated those high interest rate environment very, very well, and hopefully, maybe as early as December, maybe right. Interest rates will come down and be plain sailing from there on.
That would be great.
You mentioned Ovato. Ovato's integration is expected to realise full-year run rate synergies by FY25. Could you share more details on how this integration is progressing and what challenges, if any, you anticipate reaching these targets?
Yeah, Paul, we concluded the integration 6 months ahead of schedule. So just prior to Christmas in FY24, that integration was complete relative to the original plans that we set. Very comfortable with the last set of numbers that we called out on that acquisition. So revenue of $145 million, EBITDA of $25 million and NPAT of $13 million. And we've got that full run rate of those synergies and of those revenues as we head into FY25. We've got a clear line of sight in that in terms of what builds out our FY25 guidance number.
Fantastic. And sustainability is a growing concern for businesses and consumers alike. Can you provide some insights into IVE Group's ongoing sustainability initiatives and how they align with the company's long-term strategy?
Yeah, we're on the third year now of our ESG journey and our sustainability plan. And through that time, Paul, we've measured out scope 1, 2 and 3 emissions. Importantly, through FY24, we've taken some important steps towards actioning a number of the strategic items in our plan. One of those was to move all of our electricity into a renewable source, which is actually into a wind farm source in Western New South Wales, big infrastructure project developed by Ovato. So that really deals with the majority of our scope 1 and scope 2 emissions moving forward, and we've made that commitment on a 7-year basis as we look to step out to being 100% renewable. We've got a number of other initiatives that don't deal necessarily with carbon, that sort of look more at the social side and our people side and innovation and so forth, as well as we look to round out that strategy. We've signed up to the Australian Packaging Covenant during the year, which is really important for our FMCG clients and particularly in the packaging space, and no doubt we'll talk about packaging soon. And we're just starting our reconciliation action plan now as well. So we've got a number of really key work streams underway there. I think what's most important to us in relation to that ESG and sustainability piece is how tightly integrated we are with our clients and our clients' expectations. And what we're finding is that we are really leading the way in our industry and our market in terms of what we've done and how we feed back into our clients on that. And in some instances, are slightly ahead of where our clients are. So we're actually becoming an advisor into some of our clients on some of the initiatives that could undertake and happen within our space. So it's been really well received.
Yeah, and clearly a lot of work, thought and time has been put into that strategy. So that's very, very impressive.
Thank you.
And IVE Group has made several strategic acquisitions, including JacPak in packaging and Elastic Group in creative and content. How do these acquisitions fit into your broader sort of growth strategy, and what synergies are you expecting from these additions?
We spent 18 months looking at the packaging sector before we made a move through the acquisition of JacPak in November last year, which was our beachhead acquisition into that sector. And we explored a number of different markets within the broader Australian packaging sector. The reason we chose the folding carton sector was because operationally and from a production perspective, it's very similar to what we do in a number of our production business units today. So we saw good synergies and good know-how already within our existing labour force and our existing business. But this was also a nice adjacency for us to move out into. It's an $800 million sector in Australia, growing at 5% year on year, so it's nice to be stepping into a growth sector there as well. Yep. And we have big aspirations to go from probably position 5 or 6 at the moment into that top 3 position as we look out over the next 5 years. JacPak's a business that turned over $45 million. We could unlock $2.4 million of synergies, and we've unlocked those as we go into FY25. They also have a further $15 million of capacity available for us to fill off the existing footprint and off the existing structure. So really good synergies and uplift both from a revenue and a cost-based perspective when we look at that particular acquisition. And we're now charting a course towards $150 million of revenue in packaging in 5 years' time. And the first part of that is going to be the expansion up into Sydney, which we're going to do in FY25. And we're going to build into one of our existing sites in Sydney a folding carton capability up here so we can service national brands from Sydney and Melbourne, complemented by a third-party logistics network right around the country.
And with the fragmentation of the media landscape and the proliferation of the marketing channels, how is IVE positioning itself to capture a larger share of the market, and what role does the recent acquisition of Elastic Group play in this strategy? Yeah,
I think one of the things that's really obvious for us, we have 2,800 clients, is that when you're working with their clients around their content and you're managing their content and you're managing their data, you're very sticky with those clients. Yep. And IVE as a company can execute through any channel a client wants us to execute through. But it was also clear to us in the last 12 to 24 months that we needed to be doing more in creative and content to reflect that fragmentation in the media landscape that we see today. We've always had a service and a capability in and around creative services and content management, but that needed to be really enhanced. We've done that through 2 ways during FY24. We've employed a lot of talent to deal with strategy and creative and different thinking in that space. And then the second part of that was the acquisition of Elastic, which completed at the end of May 2024. And strategically a really important acquisition, not a big business, 40 staff, Sydney and Melbourne, fully integrated into our sites already, but strategically really important when I think about the capability set they bring to the table, which is around television, motion, social, content and docuseries. They were all capabilities that we didn't have today to be able to take to our client base. And we're only 3 months into that acquisition, but it's been extremely well received by IVE clients and extremely well received by Elastic's clients as well.
Clearly a very strategic acquisition.
Yeah, that's right.
I get the answer now. And Lasoo has exceeded expectations with its performance in FY24, I think generating an annualised GTV of 16 million. What factors contributed to this success, and what are the next steps in scaling Lasoo to reach its new targets?
Yeah, 20 months ago we re-platformed a site called Lasoo. We had acquired it in January 2020 through the acquisition of Salmat. It was a completely different website, if you like, at that point in time, and we've really taken it, launched it into the market as a consumer e-commerce marketplace, completely re-platformed, rebranded, relaunched. So it's only 20 months old. We've been really impressed with the growth that we've seen through that period of time. And as we've exited FY24, we're on a gross transaction value of $16 million per annum, as you've just alluded to. We've got 335,000 monthly active users coming to the site. The average basket value is over $200 every time someone is buying on the site. We've got over 200 retailers and brands on that site and over 200,000 SKUs. So I think for a relatively new marketplace, there's some fantastic metrics inside 20 months to get to that level. And it's well ahead of the original business plan that we put down with the board. So as we reflect on the future of Lasoo and where we're going with that, given it's a marketplace that has been losing $4 million after tax NPAT for the FY24 year, we've been really encouraged about what that looks like. We've said to the market before break even was in FY26, but we're going to commit more into the consumer marketing side of this business over the next 3 years, which will push that break even out to FY28, but it will change the GTV from $50 million in FY26 to $150 million as we approach FY30 with a break even in FY28. And we think that additional investment and the decision to defer that break even period by a couple of years is really important to get the scale in that marketplace. And it's all going towards the consumer marketing dollars. So there's no more investment required in the platform. There's no more people necessarily required for it. We've got the ability to scale it, and it'll be about the numbers, Paul.
And looking ahead to FY25, you provided guidance range for NPAT. Could you walk us through the key factors underpinning this guidance, including the expected contributions from Ovato synergies and JacPak?
Yeah, so the guidance is $45 to $50 million of NPAT, excluding the Lasoo loss for the year, which we've said will be broadly consistent with FY24, and excluding significant items, which we're calling out as being $2.5 million in FY25 and coming back to more normal levels. The 45 to 50 million reflects the full year or the full integration benefits of the Ovato acquisition, bearing in mind that we've been unlocking those integration benefits right through FY23 and FY24 as we've continued on that integration. And it reflects a full year of JacPak. So JacPak had revenues of $28 million in FY24, but on a full year run rate, those revenues will go north of $45 million in FY25, and that includes the unlocking of those synergies. So that's how we've really built out, along with organic growth in those business units that we're still driving good base organic growth. That's how we've built out that range of $45 to $50 million of NPAT for the market.
Understood. And then you mentioned ongoing investment in Lasoo, given its better than expected performance. Can you share more about your investment strategy and how you plan to enhance customer experience and scale the business further?
Yeah, I think in the Lasoo space, Paul, if that's where your question is, it is literally about the consumer marketing spend. It's about the level of investment that we're putting into the marketing space to attract more customers to the site, to ensure we've got more retailers on board, to ensure that our conversion rate is optimised, that our average basket value remains at a high number, and I think above $200 is a really good high number for that site currently.
Which is up significantly from the year before.
That's exactly right. Yeah. That number was south of $200 a year before, and also that we are continuing to execute good technological advancements in that platform from the in-house dev team that we've got, and we've got a range of features that we're continuing to release as we go through H1 FY25.
Matt, it's been an absolute pleasure. Thank you for sharing your insights on those results. Great to have you here today.
Thanks, Paul. Really appreciate it.